See here.
All right.
There you go.
We are recording. Thank you so much for technology working today. So hello, everybody. Thank you for joining us on a Sunday evening at 7 o'clock Eastern if you're out here on the East Coast. My name is Alex Brashears, and I'm an admin for Hampton Roads Multifamily and More. And tonight for our Spotlight Sunday event, we have Mr. Billy Brown, who is a commercial lender, and he's also an active investor in the multifamily space. So he has this unique perspective of being able to walk on both sides of that line. So he's here to educate us a little bit more about the financing side, the lender's perspective of all these multifamily deals we're all out there hunting. So go ahead, take it away, Billy.
Well, thanks, Alex, for having me. This is fantastic. All the way here from Nashville, Tennessee. My short introduction is I'm an investor who's also a commercial lender. The company I founded is called Investors Capital Group. We actually educate, empower, and amplify real estate investors' wealth. I'm also Amazon #1 bestselling author. We just got a book released. If you guys have not picked it up, Success Habits of Super Achievers. If you got any Def Leppard fans out there, Phil Collins in it. And your friend, Dr. Amy Novotny, Dr. Payne, Amy
Yes.
Novotny, she's anti-pain. I'll say that. I'm recording this. She's awesome.
Right.
But yeah, that's kind of the gist of it. So both as an investor and as a lender, so we can look at both sides of the fence. We're heavy on education, but also can facilitate lending. We're entrepreneurs, and we created our business kind of uniquely, where we only take on a certain number of clients each month, and it's about 20. The rest of the time is we can go invest and go create our thing. So again, another project going on right now, actually not even involved in real estate, but it is an investment. We're doing a 506C syndication on it. And that's pretty cool, because once you learn how to syndicate, once you learn how to do this, learn how to power lending, not only private, but personal and institutional, the world's your oyster. You can do anything you want to once you see the numbers work. So.
Absolutely. So when you say you take on 20 new clients a month, what type of clients is that?
Yeah, so we're concierge. So we've got myself, Carly, who's my processor, and Tammy Thrasher Mitchell, who's our director of Curious Conversations. She'd be a great guest for you to have on. And then we have an underwriter named Asher as well. So we do anything from for investors from the single family, the cash out refinance where they can't get it done through Fannie Freddie, up to the portfolio lending of like, hey, I've got 20, 30, 40 properties that are Fannie Freddie, and call them Fannie Freddie out, cross-collateralize that into we call non-recourse lending. So it frees up your ability to go borrow, takes it off your personal guarantee, to multifamily lending. Bridge lending, we'll talk about kind of how this works. We can do self-storage, we do SBA, we can do all sorts of really anything. We like to say we actually reverse engineer lending. This is an investor, you know how it pencils. You know what it looks like as far as like, I need to get to this type of debt structure for it to be profitable. So then we back into that going, all right, well, if you need that, then here's our lending options. And then go find, place that type of lending with our clients to make sure they maximize profit. Sometimes they actually don't think about the different types of lending available, and they just miss it and go, no, if you do this over here and do this and this kind of sequence, then you get a lot higher leverage and a lot higher multiple of your money.
Absolutely. I personally, as a chemistry professor, I thoroughly enjoy the working backwards aspect of it. That's why I enjoyed our conversation so much the other day. So just for the people that are maybe new to the lender space for multifamily, do you mind going over some of the just kind of broad-based options that are out there? And then we can maybe dive a little deeper into each one, that each property might be applicable for what type of loan?
Yeah. So first and foremost, this is my go and say right here, is the lender is your friend. Repeat after me. The lender is your friend, not your enemy. If they say no, there's a reason. But also you need to be able to communicate. It's on you to be able to know what type of lending is available for your project when you go see a project identified. We're going to go basically over the decision tree here in a second as far as just specific to multifamily. So you guys have a good idea as you see projects, what type of lending is going to be available for you, as well as the interest rates, closing costs, and all the fun nuances there. But you've got basically, off the top, and let's see, how many are there? So the first one is, we're going to start with this one, which is agency debt. So that's the glorious unicorn, like, oh, you get agency debt, which is all fantastic. Then you've got CMBS, which stands for commercial mortgage-backed securities. You have MBSs, which is mortgage-backed securities, is CMBS. Then you have life insurance companies. They're mainly do low leverage, usually refinances, repositioning from a bank. You have your community banks, which are fantastic, depending on the size of their portfolio and deposits on the files, how big they're going to go. You have CDFI, which we'll get in that later. Can't, I'll tease you there, close the loop later, what that is. And then my favorite, and your favorite of all time, sellers. Sellers are some of the best lenders out there. We won't talk about that right now, but once you know, this is one of my favorite things from that's out there, is like you have to know the fundamentals before you get creative. And once you know the fundamentals, then everything falls into place. You actually can be creative. So you actually can leverage and throw lenders under the bus when you need to, when you're talking to a seller, going, hey, this property is no way in the world going to get any type of lending whatsoever. So why don't we do this? Why don't you be the bank for a little bit? I'll do the work, and then we'll get real banking involved once it's stabilized and take you out, or never. So it's a lot more fun. We've got we try to do owner financing on as many properties as we can, because it's, lenders suck. No, did I say that? No, lenders are great. No, but the headache that you're going to go through, so you try to avoid it as much as possible. It's like, well, I know it's going to do this, but also I want to use the tools and the millions of dollars and resources that these lenders have at my disposal and hide behind them, because they're going to request out of you to be able to step up your game and level up, go what they call going pro. So you got to get all this information for them to get a yes, but also they provide information as well to make sure that what you're providing matches, and that's the beautiful thing, is when you go with a legitimate lender that you're not going to go in over your head. So hopefully that helped out there. I kind of went down the path, so sorry about that.
Absolutely. So I'm curious, as someone that does the commercial lender side of it, obviously seller financing sort of ropes you out of the deal. So are you involved at the seller financing when they come, to refinance out the seller once maybe the property's been stabilized?
On my side, not really. I'll give them the ideas. If they want me to come and negotiate for them, that's fine. Then we'll charge a little consulting fee on that, but also have first right refusal on the loan, the end debt. Sometimes it's just like, hey, I'll tell you what to do here, and then we'll sign an agreement. You come back to me on the permanent debt, when that is 6 months or a year from now. And I feel like if I provide that, then I've earned the right to ask, going, hey, I gave you this option, didn't even know it's there. I showed you how to negotiate and position yourself as well as us to win and, maximize and multiply your profits. So give me a shot at the lending.
Absolutely. So, yeah. Adding value where you can. I love it.
Yeah. So we just add value. Yeah.
What type of financing do you normally do, I guess, most frequently for the types of projects that you're closing on?
Right now, because the Fannie Freddies are so difficult, it's more CMBS and CDFI. CDFI has a lot of money, and that's community development finance. Oh, Jesus. I'll get that to you later. Sunday nights. I just forgot. Anyway, it's a nonprofit. So they partner with the governments and local banks. They actually go after workforce housing, and they'll have a lot of the stickiness that the agency debt guys do. So you got more flexibility there, especially if you're going after, maybe some Section 8 housing or something needs, a lot of uplift, or you just don't fit in that bucket for the agency debt. So CDFI is pretty cool.
Okay. So I guess, do you mind running through maybe what an ideal property that would qualify for agency debt, since that's the first one you mentioned? What are parameters for property for agency debt?
Yeah, and I apologize. This forced me to actually do this. I've actually got the little tree right here. I just got to go draw it out. So we do have an ebook on the basically leveling up and using. It's called the Guidebook for Real Estate Investors on Commercial Lending. And I've got a supplement in there coming called the multifamily supplement. But I don't actually do a visual. So you forced me to go do a visual here. But in words, basically, if and everyone can kind of agree, I mean, raise your hand if you don't agree, that agency debt is the end all be all for investors because it's, I mean, it's government backed, government insured really. You got basically 1 to 2, maybe up to 4 years eventually of interest only. You can add some CapEx in there to improvements, usually $7,000 a door. You got low interest rates are sub 3% right now for some big stuff, and 30-year AM, and of course non-recourse. So it's amazing. Usually close pretty fast too, relatively, 60, 75, 80, 90 days, somewhere around there, start to finish, which is pretty good. So if that is your end all be all, then you've got to evaluate each property going, can I get that lending for this property? So I'll ask the questions you need to ask yourself is this. So on the agency debt, is the loan amount greater than $2 million? Okay, well, wait a minute, Billy. The SBL, small balance lending, it says 750,000. Why'd you say 2 million? Well, because two things. One is there's so many properties out there looking to be refinanced, repositioned, or sold that the brokers out there that broker these, the Walker and Dunlaps and so forth, are not going to mess with a new person under $2 million. Maybe an existing person, but not a new person. It's not worth it for them. They're going to ignore you. It's just not worth their time. I mean, they can go make 3 times as much money on a $5 million loan on an experienced buyer that can do it this fast versus hold their hand on somebody new. So that's the first one. So is the occupancy, so if you got over $2 million loan amount, not purchase price, if the occupancy is over 90%,
okay,
for 90 days, and it can be verified. And ask me how I know about this one. We'll talk about that later. The borrower's net worth must be at or above your loan amount. Ooh, so you got $2 million loan amount. Okay, great. And I got 90% for 90 days. Great. But also my net worth has to be over $2 million. Yes, he does. All right. Well, between you and all your team there. Okay, now what about experience? Experience matters. You guys need to know experience matters a lot. So do you have experience running and managing the number of doors you're buying between you and your team over the last 2 years, 3 years? There is some staggering in there. I'm not going to go into details here, but if you're going from, hey, I own 20 doors to go buy a 100-unit apartment complex, what's going to happen? Well, I've got a property manager. Well, the property manager going to fire. Ask me how I know on ours. So you need to have that experience on your team. It can be aggregated. That's the great thing about the multifamily is you can actually go borrow experience from folks. You and I can go do something because you have the experience and I have the experience, and together we have a lot of experience. That's going to make a lender feel very comfortable. So those are the 1, 2, 3, 4, 5 things that you need to worry about there. To be able to get into the project. Now that assumes that the property will debt service. And here's another thing that people don't know: lenders will lend you any amount of money that they want to on any project, assuming all those things are above there. It doesn't matter what lending is, so long as the debt service is right now. Looking backwards, what is it projected? Lenders don't lend on hopium that it's going to go do something. Actually, if you buy that, that's called a job. It's not called an investment. So what is it cash flow right now? That's what they'll lend up to. So if it debt services at 125 at 50% leverage, they'll lend you 50% leverage. What does that do for your cash on cash returns for you and your investors? That's the other thing. So that's a lot there. So if there's any questions out there, I want to stop here, be able to give space to be able to ask questions.
Sure. Anybody that has questions throughout this, just feel free to drop it in the chat box, and then I'll go ahead and kind of check that periodically. And then we can also put Billy's contact information in the chat box at some point as well. But that's great information there. Now, I guess the next one you mentioned was the CMBS. Yeah. What sort of requirements would a CMBS require?
Yeah, so actually it mirrors the agency debt, but their loan amount's a little bit lower. So they'll go from 750,000 up to, well, whatever it is. But they're going to be in the lower occupancy as well. So they'll go down to sometimes 50%, sometimes 85%. They prefer the higher occupancy, but there's different types of CMBS lenders that like different things. If there's a value add or a borrower that has experience right sizing and repositioning some of these assets, then the CMBS is a good place for them. And those are also non-recourse. So it's going to debt service. That's most of debt service there. A lot of these CMBS lenders actually will still require your, just like agency debt, your tax returns, but it's just for the file. They're actually not going to look at your tax returns. That's the beautiful thing about these type of loans, the asset-based loans is lenders is they only care about the asset as far as the cash flow. They don't really care about you. They do, but they don't really care, as much. I'm not going to do a deep dive into your tax returns, your add backs and all that stuff. They're just like, why? That's a beautiful thing. So they're going to do in the on the lower occupancy, and they're going to do on the lower loan amounts as well. So it's like, oh, okay, well, you still got to have the net worth experience. And oh, here's the other one. I was trying to read my handwriting. This is that here. Here's the one that throws people off. It's the 100. Go back to the multifamily. I knew I missed one. That's why I had notes. The 100-mile rule. Somebody has to be on your end of signing a loan within 100 miles of the asset. So
I did not know that. That's something new.
Yeah. It's and even in life insurance companies as well, you got to have within 2-hour drive or something like that, which is okay. If you're in LA, that's what, 15 miles, but DC like 5 miles, but no, you got to be within 100 miles. So now you're thinking, well, how these guys are in California buying these things in Dallas? Like, well, they have somebody in the GP that is in that Dallas metroplex area.
And so is that for everything you've mentioned so far, or is that just agency debt?
For sure, agency debt. The CMBS is actually a little bit more forgiving, usually a couple 100 miles, 2 or 3 hours. Or there's got to be somebody there. There's got to be a good reason for them to lend to you for that asset in that location. It's not like, hey, I got this. I'm a rich guy in LA and I want to buy this thing in Little Rock, Arkansas. Okay, well, when the what hits the fan, not if, but when the crap hits the fan, like how quickly can you get out there and go manage the managers? The people don't understand, like, so the newer investors is you got to think about this as you're buying a business. The business is housing, in this case, multifamily. So you're buying a business that provides housing. That is a business. It has to be profitable. So things are going to go wrong. What can you do, and what's your experience to know how to right size this when it does? I mean, we had, give you an example of our story. So we syndicated our apartment last year. The first day we bought it, we had a death. We then had a property manager's accounting team that just completely screwed up all the CapEx versus maintenance. Now, like, why is that important? Well, you cannot get reimbursed from the lender if it's on maintenance. It's got to be CapEx. So that took a while to go do that. Then we actually found out our project manager at the lender left, and we couldn't find them to basically get reimbursed. And then we had COVID shut down, and then we had a fire. So yeah, you gotta know how to right size these things. This is for any business. So it's just the business is multifamily. So that's why you got to have experience doing this. You can just have like money and go invest, and I want to go buy a multifamily. Any questions on experience or anything like that? I kind of went down a rabbit hole there. So
no, I think that was very clear. And then I think the next one you mentioned was the
CDFI.
CDFI. There we go.
Yeah. So that one's a fun one because then you're talking about, well, if it doesn't fit in those buckets, we won't want to touch on life insurance because that's a little harder to get actually than agency. The CDFI is community development. They want to go lend money to go improve the community. And they'll get a little bit riskier out there. Their rates and their terms and their leverage points are pretty aggressive. They'll do 30-year amortized. They'll still do recourse, but they don't really care as much as where the borrowers are. They just want to make sure it's an improvement that can be shown to their board, like, hey, they're buying this and improving it, and it's going to be for workforce housing. And it's got to have that feel-good thing. It's got to meet some the rent to medium income ratios and all that, which we're not going to get into here. I don't want to overwhelm you with data points on a Sunday night. We can get that to you guys later, but it's got to have that feel good story. Like, oh yeah, like Alice is coming in here to Southeast Nashville, and she's actually going to reposition this 48 unit apartment complex, and it's the previous owner just kind of milked the tenants and hadn't put money back into the project, and it's just she's going to come in and improve it. Yes, she's going to improve the rents, but they're still under the median income here, so we're good with that, and we want to provide her the construction loan plus the permanent loan to be able to do this. And they're going to work with you, and you got a person there, and it's kind of like a community bank feel, because they're vested in this. They have to go to the board and show how much money they lend and what's the return, and that social proof, the social capital to be able to show. So that's actually a really good one. There's a bunch of CDFIs out there. You just got to go search for them for wherever you're at. So they don't really care about where you are, as long as the property's in their backyard. It can be serviced, usually state by state. There's additional funding out there for the cities. They'll help you walk you through that, the government partnership stuff. And a lot of stuff is still going to be the same as far as your, right now, as far as your escrow for, a few months payments up front, down payment, debt servicing, that type of stuff. So it's a great alternative.
Are there any certain property parameters or maybe market parameters that particular type of financing is going to be looking for?
It's all in their backyard. So you just got to have those conversations with them going, hey, again, Google search, most of them have a state CDFI that actually handles the entire state, like person there. Sometimes there's several of them, because depending on the size of the state. You just got to ask them, like, what do you specialize in? Some do SBA lending, some of them do, for the housing, some do other things, but they'll get their mission driven. And sometimes they partner with local stuff. So you just got to ask those questions. And in fact, that's actually what I encourage people to do the most, is instead of going finding a project and go and talk to a lender and going, go lend money on this to me, is go ask the lenders, like, what do you want to lend on? Have conversation with them about what they want to lend on and why, and have many conversations. We did a November 11th. I had probably the first ever. I don't know if anyone else has done this besides some boring, mortgage, banker thing. But I had all four lenders on one panel at the same time, and to be able to hear from them what they're looking for. And it's such a great contrast for people to go, here is, what does an agency person want? What does HUD, want to lend on? What is life insurance want to lend on? What is the CDFI want to lend on? So it's very cool. Yeah.
That's great. And then you mentioned doing some SBA loans. Do you mind touching on some of the SBA loan parameters and what that process looks like?
Yeah, SBA is not going to lend on anything multifamily. It's going to be considered owner occupied. Lots of flexibility there. They are one of the only lending sources that will be a pro forma based. So if you have a startup, that's good. It's very obviously difficult right now in COVID to do it, but actually you can do it on buying a daycare. You can actually do it with self-storage, even ground up construction on self-storage schools. I mean, they're great little things like that. So there's a lot of places you actually go put these SBA loans. I think RV parks will qualify. Not mobile home parks, but RV parks will. And yeah, an SBA is like the FHA. It doesn't lend money; it just insures it. So you still have to partner with a local bank, and that's where the SBA partners with. Depends on which type of SBA facilitator you go with, either one that's actually at a bank or a private one. They go find a bank to participate this thing out. So it's a win for you.
And I've heard operators mention, especially when they're doing like a heavy value add or maybe a heavy lift, they're acquiring bridge loans. Where would bridge loans fit in this kind of breakdown that you've been talking about?
Yeah. So you kind of think about it as it falls down into the decision tree here. Is mainly on occupancy and size. If there's a low occupancy under 50% and you've got a size, size actually doesn't matter, but like $500,000 and above, and it's like too much of a workload for a community bank and you actually need to close fast, that's where you actually come in and do the bridge lending. Yes, it's expensive, but it's fast. You still get to partner with the resources of the bridge lenders, because they'll check your work for you, but they can close in 3 to 4 weeks. Now you still have to have, you still have to have surveys, your environmental ones, you still have to have your title work done, you still have to have your pro forma, you still have to have like all the things that you need. They're just not going to check on your credits, your tax returns, anything like that. It's going to be a fast go. So that's where he actually can leverage going, well, he wants up here, but he also knows that it's going to take him a long time. No one's actually going to touch this. Like, well, if I offer down here and close it in 4 weeks, the profits there. You get all your profits on the buy, as everyone knows in real estate.
Yes, absolutely.
Yep.
And as far as the different types of lending that are out there, I know you mentioned go out and talk to the lenders first. How would you recommend people go out and start that conversation? Where would you expect them to start that conversation?
Community banks. I mean, start with your community bank lenders. They'll usually have a fund to go take you to lunch. But you want to come in with a relationship mindset, not as like, hey, you need to go give me money. It's transactional. What's your rates? So the first point here you guys need to know is if the first question out of your mouth is what are your rates, you're done. You're over. They will not talk to you and they'll not pick a phone ever again. They're not answer your emails at all. Won't do it. Rate is a product of cost of funds based on risk. Mm-hmm. That is all dependent on what you're bringing to the table as far as the asset, as well as you as a borrower. How do you mitigate the risk? Lenders look at you as a risk. How do you mitigate that? So you have the conversation of how can you solve their problem, which is, as a community bank lender, not me, but like from their point is they got to have all sorts of different quotas, lending, deposits, open accounts, all that. So you got to ask them from that standpoint, going, what's your major focus? What do you like to lend on? What is your ideal client? What's your ideal type of scenario? And like, don't let them off with it. All it depends. Like, we'll take anything. We'll now get specific with me. And just have those conversations, and then go up and find your CDFI people and go ask them questions. Same thing. And then have the comment. Well, the agency debt's pretty out there. It's out there. Like agency debt, it's agency debt, it's agency debt. It's there. It's not going to move a whole lot. I've got some great resources on that as far as what lenders are looking for there. But there's nuances there. There's absolute nuances. But I start with the CDFI community banks because that's going to be very revealing as far as the kind of differences there, especially if you're investing in your backyard. Those are great starting points. And then if that's not going to fit in that's where you go in the bridge world and be able to like have conversations with somebody like you, somebody like me, to go, how do you go acquire this thing that needs to be repositioned and repositioned fast?
Absolutely. And that brings a good question. Since COVID, we're about 7-8 months into this now, and nobody really knows where there's going to be an ending. Have you seen any kind of differences in the commercial lending space since COVID has become a thing, and maybe kind of backtracked a little, now that we're 8 months into it? Have you seen that kind of slalom back and forth?
Fortunately, the lenders still want to lend. As an investor, I'm still suspicious because I think the collections are still in the 92, 93% range. I'm still a little worried. I would not be buying anything right now unless I knew it was that I had runway for what I'm doing. Lenders are still going to require that 6 to 9 to 12 months of escrows up front. So you got to be prepared for that. It's more money up front. They're going to want more debt servicing off existing, not off pro forma. They're going to require a COVID questionnaire as far as what are your plans for obviously the physical cleaning of it, but also the management of what's going on. What do you how do you go protect your employees? How do you go protect your tenants? How do you go, what's going to happen if this happens again? How much do you have in reserves? What's your reserve plan? I mean, there's a whole probably 2 or 3 page questionnaire there on what you need to prepare for. Both the community bank lending, CDFI, all up to agency. So reserves is going to be key. They're going to want to see what the thing performed at pre-COVID, during COVID, and then out of COVID. So it's kind of like going to dice it up because you start putting a property under contract now, you're probably not closing until February. So it's almost a year. So you're going to see that cycle there. Physical occupancy versus what's collected. That's gonna be the question. I mean, we already know sellers lie and pad the rent rolls and lie about their collections. So has this affected even more? And you're also inheriting. I mean, you still think about this. You're still inheriting. A lot of these states, you actually still can't evict people. There's a backlog of evictions. So, like, well, what's your eviction plan? And these people live, for free. I wouldn't be buying any right now until everyone's evicted. That's out of it. Gosh, there's one in Huntsville I was looking at. Like, their lost to lease or lost to collections is like $150,000 last year. No, year to date, $150,000. Like
On what size project?
Like 120 units.
Oh, wow. Oh, wow. Oh.
But it's Huntsville, Alabama, so there's major upside. So like no, I mean, there's a couple lenders I know that will take that. There's a depository lender and a non-depository want this thing, but it's like, good Lord Almighty, he says, yeah, it's all management, man. It's all management. So
wow,
just be careful out there what you're buying. Just be very careful what you're buying and ask those questions about, hey, and this what I love about multifamily and the commercial lending. Actually, you could ask for, Alex, I know you're selling this 82 unit apartment complex. So if you provide me all your rent rolls and your P&Ls for the last few years, also your tax returns, I'd like to see your Schedule E for the last 3 years. You get to ask that. Not that your Schedule E and your P&Ls aren't going to match perfectly. I mean, everyone takes a little off the top to get paid for stuff, but you want to see by how much. What are you actually reporting versus the paper? Because your tax returns are, they're basically the audits. They're audited financials. So if they're like way off, going, hey, that's a 40% decrease in what you're reporting to the IRS, what gives? You're telling me up here saying, oh yeah, it's on papers. Okay, well, show me what's in the bank. Show me those collections each month.
Absolutely. And is that something you would do as part of your due diligence before making an offer, or during the due diligence process after you've made an offer and it's been accepted?
Yeah, so the LOI, if you guys, raise your hand if you actually done this. So I don't want to talk underneath people. So the beautiful thing about the LOI, especially working in the commercial, see Jonathan up there saying he has, the commercial world is, especially commercial realtor, they have LOIs already templated. So LOI goes on, hey, Alex, I'm going to buy this property for you, $4 million, but you need to get me all these documents to prove that it's worth it. Here's the list. And your due diligence timeline does not start until you get 100% of those documents, and you get to review them. Not the day that you send out the LOI, it's the day that you get all of it back, because you can't go review a property without any information. So those are some of the things that I'd ask for. It's like a lender. You're like, hey, I'm going to start digging here, start poking holes. Like, where's your environmental, where's your survey, where's your rent rolls, P&Ls? All right, these aren't matching up. Send me your proof of collections. Show me in the bank. Like, well, some people are paying cash. Really? Do you actually give them receipts? Why? Like, how do you go do that? Okay, well, I got to go do estoppels. Estoppel certificates. Which even then, you got buddies of the owner in there, so no, just lie. So whatever they tell you, lenders will discount it, as well as great investors. They're going to discount your occupancy probably by 5%. So John is laughing up there. So we, in our property in Lexington, we had a heads up that the seller was not as forthright as you can say that's about everything. So we got it at a good price, which is rare. Existing 8 cap, and it was like, oh my gosh, this is fantastic. Didn't really have to negotiate a price a whole lot, but we knew like, hey, he's 100% occupied. Yeah, 100% occupied. So we ran the numbers off, 80% occupied. Sure enough, like 16 people left in the middle of the night after we got the property. So like, good, thanks, appreciate that.
So if you run into that sort of situation where you go in, you're kind of expecting one thing, you've had the conversation with a community bank and they say, here's what we're looking for. But once you kind of start digging into the documents, what do you do as far as a backup plan at that point? If the community bank has told you, here's what we're looking for, and then during due diligence, you're like, this is definitely not what they're looking for. What happens then?
Yeah, it goes back to decision trees. Like, why would they say no? And get them to tell you is like, hey, why? What are you gonna say no on? What is it about it? because you should be able to answer the experience level and the net worth level and the cash and all that on the front end. Is it not debt servicing? Is it not in their backyard? So those are the ones you just got to ask, like, what's the deal? Because they're going to be the ones that are going to be more open to working with new people. It's like, okay, well, what are you bringing to the table? You're bringing deposits. Are you going to syndicate this? Maybe they don't have room in their bucket, or maybe it's November 22nd and they're going on vacation starting Monday, and you can get a hold of them. That's the other thing. So just also timing. So you just got to ask those questions and don't be offended. Have multiple conversations. I'm not saying shop around. I'm saying have multiple, 2 to 3 lenders that like, hey, they align with your vision for what you want to go acquire, and they want to partner with you with that. You've got to have great partners and great team members. Lenders are one of them. Brokers are one of them as well, because there's a point at which you can't have those conversations all the time. Those lunches are getting caught up with those banker lunches because they're busy, you're busy. You can't do this. This is not going to happen as much in 2021. So you got to be able to have have a broker, have multiple lenders that are going to support you, because they can go fill in the gaps where you can't. So you can go focus on the number one thing, which is finding great cash flow producing properties through great resources.
So going back to number one, do not ask people about the rates. As a private lender, I fully support that. Don't do that. It drives me bonkers.
Click.
Yeah, done. So when you are having a conversation, if they do find something to due diligence that you're like, oh, they might not go for this. Are there some things that we as a potential borrower or we as an operator of a property could offer as risk mitigation strategies? Just say, oh, I know this is a problem, but maybe we could work out something else to kind of help, push this along. What would some of those strategies be that you could offer?
Usually it's cash. More down payment, more skin in the game, more reserves. That's going to make them feel very good. This means more of a raise. Sometimes it truly is just like, hey, this is a massive lift. We don't like this thing, because they're looking at it from the point of, it doesn't matter which lender it is, and it's even you think about your own money. If I have to take this back, how quickly can I sell it, and for how much? Because they got to get it off their books. They don't want to manage it. They want off their books as fast as possible, because they get in trouble by the feds if they have too many loans in default on their books. So that's that is again, think about from their viewpoint of like, what don't they want to happen and what do they want to happen? So cash is usually the best one. Additional borrowing strength, additional collateral is always helpful. Hey, well, I've got these 2 properties or 3 properties over here that are paid off. Why don't you just take those as well, take a lien on them for a certain amount of time? Not indefinitely, but for a certain amount of time until we get the same repositioned. Would that make you feel better? Yeah, that makes you feel better. You just got those are the things once you know fundamentals, you can actually be creative in. It also goes back to like, they may not have room in their bucket, because they, when they talk about community banks, this is community depositories versus non-depositories. Depositories only have so much money; it's limited. So they're going to divide up their deposits based off of asset classes. How much car loans they want to do, how many small business loans they want to do, how many whatever down the road. And they have multifamily. In this case, well, we got this much multifamily, 10%, and we got 15, 20 million. We only want to lend out there, which is small, but say 150 million. But then again, they have these people like Alex and Jonathan up there who's like rocking it out, going, hey, I know these 2 are going to put me in for 100 million a year, maybe 120 million. Like, this is my guys. We're going to keep them happy, keep going. It makes my life a lot easier as a lender. Well, that only leaves a small amount left there for new relationships. So what can you do to go, raise your hand going, you need to gamble on me? And you can't be bringing them crap. So you got to bring some great properties with a great team. So knowing how to position yourself and what you look like financially is massive. But also, there's this properties that's not going to fit in community bank standards at all. It's not going to do it. So you got to look outside of it, CDFI, bridge lending, all that. And sometimes you do ask those questions going, okay, you said you don't like this property because it's not stabilized. If it was stabilized, would you like it? What would that look like? And then you could reverse engineer that. Okay, well, if you like it at this, and I can go this way. Okay, well, if I brought you this, could I actually reposition all the equity, or just how much I put into it, or how much do I owe? Tell me what that looks like. And then you can kind of back into what you need to offer and what type of loan you gotta do. Because that's when you just gotta get a bridge loan. You just go, hey, we'll bridge it, we'll reposition it, take 18 months or so, and then let the other lender take it out.
Yeah, that's very good. We did have a question come in.
Yep.
Do lenders usually provide you with a list of commercial or multifamily properties that are in default or in pre-foreclosure if you ask them?
No, unless you ask nicely. They actually do special servicers. So you got to actually know ahead of time. And that's where, again, go back to relationships there. And I'm not laughing at the question. I'm like, if I knew that, like, how much money I can make off that, just selling that list. Now it's the process or default is, you have covenants on there as far as, especially on the community bank side, how much your property debt service, how much you have in reserves. And if those covenants go down, you got to have your report card, like businesses, quarterly. So how's that performing? If you miss those, then it goes in the special servicer and you get to the principal's office. Not to say a bad thing, they're there to help you out. So they'll provide resources. If there's points you just go, like, you get mad at them and they work with them, then that's where they go, okay, we're taking the keys back and we're coming after you. And that's where they try to do a workout. The other collateral, that's attorneys involved. And that's the legal side of stuff where things are so messy, you can't go untie that property to go get clean title. So you got to know ahead of time who's in trouble. Well, how do you find that out? You talk to your lenders. And you let them know that you're a strong borrower and have strong assets and a strong team. Maybe you're doing raising a blind fund to go to, like, that's the conversation is like, hey, we're raising a blind fund here. We're actually buying stuff, but also we're actually taking properties out of the troubled asset bucket of your bank. You mind keep me on your list if you hear anything that's about to go there, that we can go help out, because they don't want that on their balance sheet. They don't want going over there because that's bad. That's very, very bad for them. Lose their credit rating, loses their cost of funds go up. Bad things happen. So they're going to try to work out. So if you can help them by repositioning that asset, then that's a win for everybody. But you gotta schmooze. You gotta have those conversations. I do this all the time when I talk to lenders. That's why I'm an investor first, and then I have the lender hat. But the investor hat is like, hey, just by the way, keep me in mind. Like, hey, we can. I know, like, there's all sorts of transitions within your bank. I know you do a lot of lending for investors. If you get to the point where actually you're oversaturated with your investments on the one forward, let me know, because I can do a couple things for you. One is take those loans and refinance them off their book, and non-recourse on the link, or actually can trade that out and actually have someone else buy the notes from you, so it frees you up. And oh, that's great, that's fantastic, I'll let you know. It's like, oh yeah, by the way, I'm also an investor, so if any of those are becoming default or get close to it, we have groups of people I know can come in and rescue those before it gets too late. They go, oh, I gotta get you hooked up with my special servicer. I provided a solution. If you provide a solution to their problem, guess who they're going to call?
Yeah,
you got to stay in front of them. So lenders have a short attention span. So they're kind of like Dora the Explorer. You just or not Dora, Dory the fish.
Yes, that's awesome. What a great mental image.
Yeah,
that's awesome. I love it. Now, you did bring up a good thing to talk about, partnerships, bringing on, because certain people, there's a lot to evaluate when taking on a partner or taking on partners. It's a little bit more than, hey, I get along with this person. So can you talk about the various aspects you want to consider when you're looking at taking on partners from a lender's perspective?
Yes. So let me talk from the investor's point of view first, because hopefully this frees people up. No one here has everything needed to succeed as an investor. You don't have all the pieces. If you think it's all about you and I have to do it all by myself, you're going to stay small. When you accept the fact that you have gaps in the pie that's needed, and you actually can go recruit people to go fit those pies where you make a strong team, that's where you explode. So the first thing is that self-analysis. What do I bring to the table? and what am I not good at? And you go find people that are good at the things you're not good at. That's the first step. Lenders love teams. Commercial lenders want to lend to great teams, not great individuals, great teams, because if you get sick, if I get sick and I'm the only one that's in trouble, it's a single point of failure. Everything implodes. If you have a team there that works as a system, and you show them systems and you show you're professional, they want to go out of their way to go help you. And that's how you position yourself when you should go do for lending, is on your bio for you and your team, as you list out basically the strengths that you bring to the table. And you make it abundantly clear, like what, together as a whole, we're fantastic. You need to borrow, lend us money for these projects because we're a rock star team.
And what would you say from a lender's perspective makes that rock star team? I know you mentioned experience for over the last couple of years, probably wanting to have something along the same lines of the number of units you're trying to borrow for. Is there anything else?
So income outside of the investment that you're borrowing. So like, hey, Nashville speak, I'm a musician, I wait tables, and I'm a multifamily syndicator.
Yeah.
Here, they're also a realtor. So if your waitress is your realtor, songwriter. So some other outside income. You have experience running something as far as projects and properties as a team. Combined net worth, liquidity, reserves, and then you live close to the property as you're buying. And also the business acumen, like when things go wrong, how quickly, can you demonstrate you actually right-sized the ships before? And that's when you have this conversation with lenders, like, hey, when I did this, and I'm always open and honest when I talk to lenders about the crap that has hit the fan with our properties and how we fixed it.
Absolutely, because they want to see track record of turning things around.
If you can always like, oh, none of our properties anything bad. We were just, we 100% like me across the board. It's like, they know you're lying. There's just no you lying. If you're honest with them, go, man, we had this fire over here, we had this death over here, we had this happen. This is what we did. This is the property manager. We got to went through a different property manager. But you know who did that? My team member did that. You know what I did? I sourced it. I did this. This is my role. My wife's role is this. So if you look at it from a team standpoint, and trust me, lenders absolutely love lending to great teams.
Absolutely. And then would passive investing count towards experience? So if someone's invested, say, as an LP in a syndication, would that count as experience?
No, it's the same thing. There's like, even though you're part of the event, you don't have any direct management experience with that asset. You've kind of been on the financial side. They may get reporting. You're not part of the management team for it.
And as far as building the management team, would you say doing that with single family homes or small multifamily, or could you get something experience wise from your job? So say you're a construction project manager for your W-2 job.
That'll carry over a little bit, but if you're like, say you build apartments, like, okay, that's your job, and you actually know how to go build apartments. Well, you signed on the loan for building those apartments? No, I'm an employee. Okay, well, employees can come and go. They don't. If the thing goes south, you can go walk away. If you sign on the loan, you're signing on the loan. So they want somebody to sign on the loan and pledge their fortune, their livelihood on this thing. So there's some experience that will change over. I love the guys that are doing the rehab in multifamily, or the single family portfolios of loans where they actually have the construction and rehab experience, because they know how to manage those teams. So they've shown that they actually can do it remotely. They've actually done themselves, actually can do it remotely. Then it's a heck of a lot easier to go lend them, because they have the experience and they know how to do it remotely. But yeah, you got to have that experience and combined within your team. So like, hey, you've got a couple units, other person's got 25, but you got the net worth and they don't. They got more experience. That all can be aggregated together.
And how is the lender verifying experience of the individual or the team?
Yeah, it's on your bio. You're presenting it. You got to come in strong. Don't leave any doubts. So, you know, it was part of our checklist, and this is on our website, and we actually do videos on this as well. We actually kind of help, like you look at the bio going, who are you? You're making a introduction to a new lender, new potential partner on the loan side. They need to know who you are. How do you come in? How do you look like? They're going to Google you on LinkedIn. They're going to Google you on, you know, Google. What do you look like? How do you present there? And then does that compare with here? They're going to make some phone calls as well going, right, does Alex actually have this? You know, we look at the PFS, they're going to say, oh, you've got these other properties over here. We're going to call that lender, actually verify that. So they're going to make some phone calls there, but you got to come in strong. Don't leave them any doubt as to your strength. They just can't, you can't assume like, oh yeah, they know who I am. Oh, here, listen out. That's why my bio is 3 pages long now. You know, I talk about everything. I talk about my lending side, you know, I talk about everything. They're like, oh, that's too much. Like, yeah, I know. I can pare it down, but I want to come in there overwhelming going, this guy knows what he's talking about as best you can in real estate, you know.
Yeah.
Nobody knows everything.
Yeah, absolutely. And anybody that claims they do is
Yeah, I
probably
know.
lying.
Yeah. Yeah.
So what I will do, since we're running a little bit short on time, do you mind putting any sort of
Yeah.
contact information in the chat for anybody that might want to get a hold of you? And if
Yeah.
I have anybody listening, oh, we do have one more question. Can you include passive assets in your net worth?
Yeah. Well, I mean, well, what example? Give me an example.
The question just came in, so we'll see if she follows up.
You can say it depends, but it depends. Yeah. Okay. So, well, we're in that. So, you guys shoot me an email. I'm actually going to send you the digital copy of this, which is the Success House book. So, we actually get the entire thing. So, read about my story, Amy Navani's story. If you're a Phil Collins fan, Def Leppard. If you want to buy these, they're $10 or 2 for 15. And if you want more than that, just let me know. I'd be happy to send them to you. Just put that in the email there. But the physical ones, I'll sign it for you if you want. It means anything. But yeah, just send me the email there. But it's a fantastic book. Oh my gosh. Have you read through this yet, Alex?
I have not. I was going to order it on Amazon this weekend, but I didn't get around to doing that because I'm redoing my deck. So I've been painting all weekend.
We don't have the audio version yet, but it's an incredible story. Lots of syndicators in here. Anna Kelly, you know Anna?
Yes.
So her story's in here from living the project, owning the projects. Incredible.
And then I know you mentioned at the beginning about an ebook.
Yeah.
Is that book, or you have another ebook?
Another one. So we got one called the Guidebook for real estate investors. So it's everything you really need to know about going from, if you bought single family homes through, you know, Fannie Freddie, and you go try to buy commercial, there's a big learning curve. How many guys have gone through that learning curve of single family to commercial?
Yeah, it's huge.
Yeah. So it's almost like the Going Pro, as Stephen Pressfield's the Going Pro book. You got to step up, and commercial lenders want to work with professionals, not amateurs. So you got to go from, there's a mindset shift as well as an expectation shift, as well as just an organization and team shift, but also like there's the nuances of, well, what the hell are they lending on? This is just crazy. So we actually walk people through that in the ebook. And I call it going from owning rental properties to becoming a real estate investor, like a real one.
And how could people get a hold of that ebook if they were interested in that?
Yeah, just shoot me an email. I'll send it to them. Yeah, just there's opt in there. That's some other fun, cool stuff. We got a video portal as well for people who want to go do more. Like, hey, I want more than just like an ebook. I want to actually learn. It's pretty cool because it's emailed to you every morning. So they're about 10-minute video segments. Like, how do you fill out a PFS? How do you fill out a schedule of real estate owned? What are the 4 C's of lending? You know, stuff like that. You go, oh, okay, that's what they're making decisions off of. Yep.
That's awesome. That's great. Well, thank you very much for spending your time Sunday evening here with us and educating us on the lending side of things. I feel like that's oftentimes a side that, you know, we kind of have to pull back the curtain and figure out on our own. So I'm glad you are coming forward and telling people this is what it looks like.
I think that's the great thing is like why people like embrace me so much is like I can be candid and honest about it, and also being an investor is like I've gone through these troubles. You know, maybe there'll be another one I actually should tell you about the office complex we bought up in Wisconsin, where I spent July 4th weekend talking to lenders because mine turned me down here. So it happens to everybody.
Yeah.
And I know how to go do this, so don't worry. But you have to go fail to succeed. That's the biggest thing. So don't be afraid of failure.
Absolutely. Well, thank you very much. And anybody who has any questions, feel free to reach out to Billy. Absolutely. Just lovely to talk to. I had a great time talking to him last week, full of information. And like I said, because he's an active investor and a lender, he has a very unique perspective for this multifamily space, just because of being able to walk on both sides, like you mentioned. So thank you very much for that.
You're welcome. Happy to help out and be glad to come back on anytime you want me.
Yes. Thank you so much. I appreciate it.
All right. You guys have a great Sunday evening. Appreciate it. Thanks so much.
You. Bye.
All right.